Today I'm going to teach you how to get into the right mental mindset for trading. Books have been written on the topic, and there's some really good ones. I'm not a psychiatrist, so I'm not going to tell you that the reason that you hang on to your losers too long is because you were breastfed too long as a baby. I'm going to give you 3 really easy steps that you can follow that should help you out. But before I get started, please subscribe to my YouTube channel. It helps my views. I'm trying to reach as many traders as possible, and hopefully my videos are helping you. And by spreading the word, you're going to help other traders as well. So let's take a look at what those 3 aspects are. It's not going to take you long, and I think you're going to be able to relate to these. So the first one is size. Okay, if you're nervous about your position, scared money never wins. So if you're over trading and you have too much of a position on, that's going to hurt you because you're going to be in winning trades where you take your gains because they're huge, they're oversized, and you can't stand the thought of seeing those profits slip away. What do? You exit. You take all of your gains on the first sign of trouble. How should you trade? If you scale into really good positions, you're taking a small initial trade, so you really don't have a lot to risk. You're weighing the price action, you're seeing if it confirms your original thesis, and if it does, you're going to gradually add to the position. So for instance, let's talk about the long side of the market because that's where we're trading currently, and the market has been in a 100-year uptrend, so most of the time we are long. If you get in a long position, what most traders will do when they have too much size on is the first red candle, they will bail on the position. That's it, I'm done. I wish I would have taken profits yesterday, but that's okay, this was a nice winner. And then what happens is that red candle reverses on the very next bar. That was just a tiny little round of profit taking, and the green candle that followed was actually price confirmation. It was confirmation that buyers are still in control and that this stock is going higher. So what happens after that? I usually have people ask me, Pete, I always get rid of my winners too soon. How do I hang on to trades longer? Well, you don't bail on that first red candle, you embrace it because it's going to tell you how much gas is left in the tank. And when the stock reverses that red candle, you're adding to the position, okay? Now instead of 1 leg, I have 2 legs. My average cost is still way below the current price. So worst case scenario, the stock pulls back, I can always stop out of the position. And I am talking more about swing trading here because for day trading, you may only have 1 or 2 opportunities to add to a position. But for swing trades that last, say, 2-3 weeks or maybe even a couple of months, you have plenty of opportunities to add. So as the stock continues to prove itself and it continues to grind higher and it's showing you relative strength, those are opportunities for you to add to the position. So your size gradually builds with confirmation. Your average price remains low and you're adding to winners. So that's how you stay in the right mental mindset. Instead of bailing at the first sign of trouble, you're actually adding to the position. And your risk is lower because you have new information. You've got additional data points that confirm that this trend is strong. One of the big problems that we have related to size is that many traders start out too big. They're novices. They don't have any idea of what they're doing. So you're jumping from hole to hole like a rabbit. You're in positions. Oh my God, it moved against me. I'm probably wrong. I'm never right. So you get out and then the stock moves your way. There's nothing more frustrating than being in a winning position, taking a loss on it, and then watching it move higher. So with regards to size, when you're a novice, you should be trading 1 share of stock because you want to eliminate any kind of emotion from the trade. As soon as that position has any kind of meaning, financial meaning to you, emotions are going to play a role. And you won't be able to go back and look at your trades and determine objectively why you got into the trade and why you got out of the trade. if the monetary amount that you're making or losing doesn't matter at all, it doesn't change your lifestyle in the slightest, that's perfect, because then you can go back at the close and you can objectively evaluate each and every trade, knowing that emotions never played a role. As you start trading one share, eventually you start getting your win rate up. Over the course of a year or two, you're gaining additional knowledge, you're honing your technical analysis skills, and now all of a sudden your win rate is starting to climb steadily. You're making good decisions. You've been exposed to many different market conditions. Your confidence goes up. So the mental aspect of trading has a smaller and smaller impact on you because you know what you're doing. Again, even after you've started to have success and even after you've started to increase your size per trade, then you're going to be oversized. If you're worried about the position, if you think that you need to hedge the position, then you probably have too much of a position on. Now, there could be some other factors that are going to be coming into play, and one of them could be selection. So we're going to take a look at some different stocks, and I'm going to talk about how that selection process really makes a huge difference. Let's take a look at some stocks. APH. I'm going to come back to this stock a little bit later, but this is a perfect example of the type of stock that you want to select. The reason for that is that, do you notice that there aren't any dips? This is like taking a straight edge and drawing a line from one corner of the chart to the other. Well, why aren't there any dips? Because buyers are in complete control. They are aggressive. They're buying everything in sight. And so as soon as some profit takers come into the stock and they try to knock the stock down, actually, they're not trying to do anything. They're trying to take profits. They're happy with the profits that they have in the position, and they're moving on to perhaps a better opportunity. It doesn't matter why they're selling. They are satisfied with this current price, and eventually that supply gets worked off, but it never produces a drop. And the reason for that is that buyers are aggressive. They are in control. So when you don't see a lot of choppy back and forth movement in the stock, it's telling you this stock is going higher. There are big institutions who want to own this stock for the next 2 or 3 years. When you see choppy price movement that's all over the place, it tells you that buyers and sellers are in balance and that sellers actually do have some say in the matter. They're able to impact price. When do we have our highest odds of predicting future price movement? When the chart is nice and tight like this. Selection is super, super, super important. It puts us in the right mindset. Let's take a look at some stocks here. And for instance, I might as well talk about APH right now because I had someone in the chat room go, "Oh my God, what should I do? What should I do? What should I do? I bought this stock up here and now it's below the EMA 8. Oh, that EMA 8 should have found support. Yeah. Should I just get out now? No! Heck no! The EMA 8 is nothing. It is not important. What's important is all of this buying that happened over the past 2 months. Are those buyers just going to throw in the towel all of a sudden and decide, nope, that's it. I'm done. I'm done. I'm out of here. This stock is horrible. Sell everything. Nope. That's it. Of course not. They have market impact costs. When they move billions of dollars, it costs them a lot to enter a position and to exit a position. They're not willy-nilly just going to change their mind. In fact, when you see a nice tight pattern like this, they've done their research. They spend billions of dollars on research. So they're not going to get into a stock and pursue it aggressively if there's a lot of uncertainty surrounding the company. So they're not going to be buy all the way up. If there's a lawsuit that's pending, if there's a clinical trial that's pending, if they're revenues have been volatile recently, if there's possible regulation that could impede future growth, they're not going to be buying stock with this type of aggression. The pattern, the stock selection is critically important. So let's go through a few picks. I'll show you some good, I'll show you some bad. If you are in the right stock, your mindset has to be, why did all of these buyers suddenly change their mind? Well, they're not going to. Okay, well, that means that dips are going to be brief and shallow, and that they are going to view those as opportunities, and they will come in and they will support the stock. Now let's get into the worst case scenario, because this is what everyone focuses on. It's, I have so much money on the line. I've never made this much money on a stock trade before. I gotta get out. What you need to do is to know that if there's news that hits the stock, okay, these guys weren't expecting it either. It's probably something out of left field. It's probably something minor. It's probably something temporary. And if you get a drop at minimum, at very minimum, the stock is going to rebound and you will make a lower high double top, because these guys are going to view every dip as an opportunity because they love this stock. And you're going to see it rebound. Now, if the stock can't get back to its recent high and you're starting to see resistance, then take your profits. But if you bail on that first drop, you are going to be really disappointed when you see that stock rebound. And it could even make a new all-time high. And here you are on the sideline. Back to that mental confidence. At minimum, if you have adverse news that impacts a stock that looks like this, you are going to get a drop and a lower high double top that will provide you with an excellent exit opportunity, and you'll lock in those big gains. That's what gives you staying power. This price action all along in here is what gives you staying power, because you are selecting great stocks that have relative strength. And relative strength tells us that institutions are aggressively buying the stock. Let's go through and take a look at a few. ASML, do I like it? Don't I like it? Well, this is nice price action, but I would not be chasing a stock that's gone parabolic. You can see this is like a skyscraper. I need to be able to enter somewhere around the EMA 8, and this didn't give us any chances to do that, so I'm not going to be taking a trade like that. STX, beautiful. This is the type of stock that you want to be buying. So up in here, there it is. I knew it. I overstayed my welcome. The stock tested the EMA 8. I'll just take my gains. I wish I would have taken my gains up here. I knew I should have taken my gains up here. That is not the mindset that you need to be in, because all along in here, as the stock is starting to move higher, you're looking for these points where the stock is not very far above the EMA 8 or even touches it. And as soon as you get this little dip and a gap higher to a new relative high, you're in here, you're buying, you're adding to positions. You're confident that these buyers are not going away. They're super aggressive. You get a dip to the EMA 8. Let's see if the stock continues to pull back. Maybe I can buy it a little cheaper. Nope. It closes on its high of the day. And in this particular instance, it might have even been related to a market drop. If the stock drops because the market is down, no problem. This doesn't even have anything to do with this stock. It's just following the market, which, by the way, the market has been very strong. And that's another thing that we're going to take into account as well. What's the market backdrop and what do the technicals tell us on the market? We'll keep going through here and take a look at some other stocks. Tesla. This is the kind of stock that you do not want to be trading when it is in this type of a phase. You see this dip? That means sellers were in control. You see this dip? That means sellers have a say. You see this rally? That means buyers have a say. In general, you are compressing in a wide range. Avoid these trades like the plague. Stock selection. You want to be in stocks where one side is prevailing and where one side is aggressive. That's what allows us to predict future price movement. This is a search, by the way, in Option Stalker Pro. It's called Green Royal Flush. It has buy signals across every time frame. And you're going to see some really great stocks. Yes, this is the type of pattern that you want. It's gotten ahead of itself. This would be an entry point right in here. You don't want to be buying it when it's this far away from the EMA 8. Now, if you're an options trader, you can sell some out of the money puts. I do that to get the first leg of a trade on when the stock has run pretty far and I want to at least make a little bit of money on it and try to enter better. But we're going to continue with the mental mindset and not talk strategy too much here. I'm just going through some other charts. No, D-Dog. No, this is not, okay, this is maybe a nice little breakout. You got a downward sloping trend line. Okay, can I find better? Yes, I've already shown you better. Why would you allocate money to a stock like this when you can allocate money to a much better stock that has a much better technical pattern to it? We want to see that continued strength, that continued move higher. So WDC, I know that's been another one. This is the kind of stock that you want to be in. These are the stocks where buyers are relentless. Stock selection. STX, let's take a look at one more and then let's go into the final point. Yes, STX. This is the kind of stock that you want to be in. So when you're talking about the mental mind game and you're talking about how you can get through, oh my gosh, all these fears, all these worries that the stock is all of a sudden going to roll over. And that is a problem that a lot of traders have, is they won't buy a new all-time high. Those are exactly the stocks that you want to buy. They've blown through every resistance level. There is no resistance. Blue sky, sky's the limit. And you can see how the stock compresses, and then once it breaks out, it gets into this steady climb. This is aggressive buying. This is what you can get behind. This is where you buy, you add, and your average cost is all the way down around this red line here. So if something horrible happened and you've got a big position and big gains, you have to make big gains when you're a trader. Okay, you have to. You can't always eat like a mouse. If you do that, you're not going to make it. So you've got to have big gains. You start out small and you build on confirmation. That goes back to the first point, which is size. And when you have a lot of size on, that's when your emotions run high. But you can quell that by making sure that you're scaling in and that your average price is always much lower than the current price. So if disaster strikes, you know you can always scratch the trade. You're not going to lose money. Are you going to give back those massive gains? Probably not. You're going to get a lower high double top. So stop freaking out, especially when you have a strong market backdrop. You can take a look at a couple of others in here. BE has been just an incredible stock. You know I love that. These are the stocks that we want to focus on. So stock selection is another way that you can get yourself into the right mental mindset. The final one, the third one, is source. What does that mean? What's your source of information? What is your source of analysis? Okay, right now, if you are leaning on fundamental analysis, then all you're hearing are the headlines. Oh my God, ADP came out this morning. 32,000 jobs were lost in the private sector during the month of September. That's horrible. Oh my God, the government is shut down. Wars, Ukraine war. Oh no, there's a war. If you look at all the headlines right now, they are so dang negative. And if you look at fundamental sources of information right now, there is so much dang bearishness out there. And yes, the economic numbers have been deteriorating, but we don't trade fundamentals. We trade technicals. And by all means, if you're getting your information from YouTube, when I'm on YouTube right now, I see market crash coming, people lose jobs, credit crisis coming, China falling apart. I've mentioned some of these in my previous videos during April and May when we had a legitimate market pullback, but the market rebounded. Okay, I was looking for that lower high double top back in April, and I was keeping my trading fairly light. So back in here, let's go back and take a look. Yes, I was bearish in here. We made money on the way down. We sold puts in here. and I was waiting to see what would happen. We had all these tariffs coming in. The Fed remained hawkish. We had deteriorating economic news. What did I want to see? Well, in here, I wanted to see resistance at these major moving averages because that would be well below the all-time high. I'm not getting short again until I see resistance here. Well, what happened? The market poked through. And this was, I think, the China trade deal. Whatever it was, the market really liked the news. And then it came back and it tested these major moving averages. From this bounce right in here, I started to change my tone and I went neutral because yes, the fundamental news was still weighing on me. I was still aware of all the factors that caused this big drop, but I wasn't as concerned because now I could see that buyers were in control. So when you look at fundamental news, it's going to impact you. The best thing that you can do is to ignore it. Just flat out ignore it. Now, I always like to be aware of things that are going on, and I look at the scheduled events, so I'm aware that there's going to be an FOMC statement or the jobs report on Friday, and I can throttle my risk based on that news because I know that most of the time it's going to move the market. So I may want to reduce my risk into those events. So awareness is always good to have. Just don't let it influence you. What happened after this retest? Now all of a sudden the market starts getting up to a new high. And this is where you have to start embracing the fact that this is going to be a nice rally. What happens technically from this point on? Well, we start seeing really strong buying. Even with all the negative things going on, this price action is telling me that institutions don't care. Trade what you see, not what you think. Don't watch all the financial media. Don't listen to what anybody else has to tell you. Just follow the price action. And you can see the tells here are that dips are brief and shallow. So you get this brief test of the major moving averages and an immediate bounce off of it. That's bullish. Why? Because these folks who missed this move were looking for any dip to get long. And as soon as they saw it, they gobbled it up as fast as they could. The market didn't come down to the major moving averages. It didn't linger around them. It didn't poke back down below them. These buyers were so excited that they bought and they kept right on buying, and other technicians saw this bounce and they knew that this was a tell. This was a tell that buyers were firmly in control. When the dips are brief and shallow, it's a sign that buyers are aggressive. When buyers are aggressive, we know that there will be higher prices, period. Could there be another dip along the way? Sure. So how do we avoid that? Well, when you get the market extending well above that EMA 8, okay, you're probably going to get a price compression. You might get a little dip, but it's not going to be the end of the world. If you're a longer-term swing trader, you don't buy and take new positions up here. You wait for that tiny little dip, and that's where you would start adding to your positions, especially when you get a tiny dip like this and the stock compresses. Stock did not go down with the market. Great. That tells me it has relative strength. That tells me that buyers are scooping up any supply of stock and that it's going to continue to go higher. So when the dips are brief and shallow, buyers are aggressive, and we can predict future price movement. So as we continue, we can see every time the market gets above the EMA 8, it drops. And then once it gets back above the EMA 8, that's a good entry point. That's a good entry point. That's a good entry point. And look at this nice steady price action. Where most traders get hung up is they see that the market's making a new all-time high and they all of a sudden get into panic mode. This is going to end. I just know it's going to end. I know it's going to end. I can feel it. The news has been bad. So they don't trade. They don't take a position. Worse than that is they start to short. Oh my God, you're going to get carried out in a body bag if you do that. We do not pick market tops. And this goes back to my earlier point. How is all of this going to end? How does this gigantic, fantastic, awesome rally end? It ends just like every other rally that I've traded over the last 25 years. The first thing you get is a really deep drop, deeper than you've seen previously. and more prolonged than you've seen in quite a while. And typically, before that even happens, you're going to start to see some volatility right at the top. So you'll get sell-off, rebound, sell-off, rebound, sell-off, rebound, sell-off, rebound. And the market will be volatile within a horizontal trading range. That's a topping formation. Okay, that tells you that you should be taking your gains on swing trades that resistance is forming. But what is very unlikely is that out of nowhere, after all of this type of buying, long-term money coming to market, what is very unusual is to see a black swan type of event. They just don't happen very often because institutions have their ear to the wall. They know what's happening. So the fact that you're buying up here and you're going to get a gigantic big market drop, very unlikely. You're going to see that volatility around the all-time high before you get that big market drop. And if by chance you got trapped by that big drop, what should you do? You should hang on knowing that buyers have been aggressive and that they're going to scoop that dip and that they're going to try and push the market back to the all-time high. And when it can't get there, you're going to have your double top lower high and an excellent exit point if you missed the warning signs earlier. So again, the point here is source. Do not lean on fundamental research. And I'm serious when I say this. I go onto YouTube and I'm seeing so much gloom and doom. And I think that's probably greater than I've ever seen before. My suspicion is that that's because of sensationalism on social media. You're not going to get the clicks if you say the market could dip here for the next week. Now, you're going to get clicks if you say, this is it, market crash coming, credit crisis, buy gold and bullets. That's going to get your clicks because everybody's going to go, oh my God, what does this guy know that I don't know? That's the only way I can rationalize it. But you can see that with all the tariff news, the trade news, everything that's been going on recently, the government shutdown, the market doesn't care. If you rely on technical analysis, you're going to be making money during this entire move and you're going to ignore everything else that you hear. So let's do a quick recap here. And by the way, please leave your comments. Let me know what types of educational videos you'd like to see. I'll take them into consideration and I'll start recording them, especially if I see that a lot of people have the same interest. 3 keys to the mental game. Size. If you have too much size in, you're not going to make good decisions. You're going to panic out of positions. You're going to be very emotionally attached to it, and you're going to miss a lot of the upside to the trade. Heaven forbid you're in a good trade that initially moves against you. You're going to panic out of that position. You're going to take a big loss because you oversized, and then the stock is going to take off and you're going to be super mad. That's when I get the question, Pete, how do I set my stops? Because I always seem to be getting stopped out of really good trades. Well, your entry is what you need to focus on and not your stop. And your size is probably too big, and that's why you're stopping out all the time. So if you scale into positions, that's ultimately going to be your best way to build a nice large position and to remove your emotions and remove any mental aspect to trading at all. And that size should not come until you've been trading for a long time. You want to train using one share of stock. You want to get your win rate up. You want to experience all sorts of different market conditions over the course of a year or two. There's no substitute for experience. So if you think you're going to come in and just go gangbusters and figure this out right out of the gate, you're not going to. You're going to be one of the 90% who fail at this instantly. The second thing that you need to do is you need to pick great stocks. Stop picking these stocks that are all over the board. That tells you that buyers have some say and sellers have some say. We want one-sided, lopsided movement. We want those 45-degree angles where the stock rallies as if someone had taken a straight edge and drawn a trend line. We want the dips to be brief and shallow. If we have that, we know that institutions are in there buying the stock. That is what gives us confidence. They spend billions of dollars on research. Let them do the fundamental research. We don't have those resources. And when they're in there allocating billions of dollars to this company, those are the ones that we want to buy, and we'll know that we have that safety net. We know that they are aggressive. Source. Don't rely on fundamental information. Block out all the negative news, block out those headlines, and focus on technical analysis. Trust what you see, not what you think, and not what you hear. Only what you see, because the technicals are going to tell you exactly what these large institutions are doing. And when the dips are brief and shallow, we know that they're aggressive on the buy side, and we know that higher prices are coming. That's what gives you the mental fortitude to stick with these positions and to ride out these little dips. And by all means, there's a process that traders go through. First, I got into a good trade and then I took profits. Okay, way to go. Excellent. You want to get your win rate up. Then kind of the next phase that traders go through is they get into a trade and they ride it. So that first temptation to take gains, that first red candle that they normally would have taken gains on, they hold through that. And man, is that a proud moment when you can hold through a pullback and then you watch the stock go higher. Man, does that make you feel good, because the old you would have gotten out way back there, but the new you rode that trade higher. And then the final phase is when you're in a position, you're riding position, you get through those dips and pullbacks and the stock makes a new high. And without hesitation, you add to the position and you add to the position and you add to the position on future price confirmation. And you ride that trade. And eventually you take really big gains. Now, when you've reached that level, now you've done everything that you need to become a successful long-term trader. Thanks for watching. Please leave your comments. I will reply. Trade well. See how we trade live every day and take our 14-day free trial. I won't even ask you for a credit card. Dive into the action and trade alongside of us. Your downside is that you get some great trade ideas. Your upside is unlimited because you'll learn the skills that you need to be profitable. Check out OneOption.com and see for yourself.